future. So joining us now for this conversation is the SEC's Director of Investment Management, a primary source, if you will, Brian Daly. He's the regulator in charge of overseeing mutual fund and ETF products. Brian, thank you very much for being here with us on Power Lunch. Let's start right away with just the news is the SEC has opened a public comment period for these novel ETFs that some say are really geared towards prediction markets-based ETFs. What exactly brought on this request for comment from the industry? Was it all about prediction markets and ETF wrappers?
Right. So first of all, thank you for having me. And to answer your question, yes and no. We've had this tremendous success in the ETF world. In 2019, the stats are just mind-blowing. It is a great wrapper. It helps retail investors. We've been looking at that in terms of a bunch of things: volume, speed, and novelty in asset classes, and really even in structure, fund structure, and how that all works. When the ETF prediction market wrappers came in, we looked at that and we said, okay, this is a good time to take stock of where we are. And what we did, and I think this is just government at its best, is we reached out to the industry. We said, we see where you're coming in with these. We have these new exposures coming in. And then behind it, we'll see what else is after that, probably perpetuals, and I don't know what comes after that. But there are new assets coming in that the system wasn't built for. And we, to have an orderly and predictable review process, want to get it right. So let's all just take a breath. You guys will voluntarily, hopefully, defer your effectiveness, which they all did, and we'll put out this request for comment, and we will collectively get all the best thoughts from the regulatory side, from the investing public side, and from the industry sponsors themselves, so that we can have a good review process for these.
What has been the early feedback, if at all, anything? It's very early in this 60-day window, call it, right? That's what it is. Have you really heard or seen anything before this period opened and in the early stages of it? What's been the general kind of feel of what this kind of product could look like rolled out to investors?
So the feedback has been positive. I mean, my inbox lit up yesterday. We put the RFC out at 9 a.m., 10 a.m., and by the end of the day, we had emails in from fund sponsors, from others who said, we are going to comment. We want to come in and talk to you. We think this is a great idea. When we talk to the sponsors themselves, as we have been doing for weeks, the feedback has been, your review process is really valuable to us. You go through, you help us improve our disclosures, you spot issues, potential federal securities law violations that we missed or we weren't sensitive to. We get a better product. We value that. But this is the ETF world, as you know, it's a winner-take-all. First mover wins. So it's hard for them to have an iterative discussion with us, to go back and forth when they're looking over their shoulder and they're saying, oh my God, there's somebody who is reading my disclosure in real time who is trying to jump ahead of me in line. And if they beat me, all my investment is for naught. That's what we're fixing.
How do you fix that? We heard this around the SpaceX launch. There were people on Friday trying to get out with their levered products before they were even officially allowed to, I think on what was it, the following Monday or Tuesday, because that first mover advantage is so strong. That doesn't seem like a great, feature of the system.
Yeah, we recognize that. One thing we did at the SEC for regular public companies under the 33 Act is we started out with this idea for emerging growth companies way back in 2012 to allow them to file what we now have commonplace, the confidential IPO application, right? You hear people, it's very funny when they go on the show and other
Jobs
shows.
Act stuff.
But they say,
confidentially filed
today we
IPO?
filed a confidential statement. It's like, okay.
Not really confidential.
Now, of course, the terms are and all the rest of it. And that was done because there was an acknowledgement with Congress, with the SEC, that it wasn't good for small upstarts to come out of Silicon Valley to put all of their trade secrets and ideas out there for everybody to look at, and for the established players to basically steal those ideas and get ahead of them in line. We have never had that. And that obviously was extended to all IPOs a few years later. We haven't had that. I suspect we're going to get a lot of comments on that are going to suggest we adopt that system for us, because we do that now. We get an application in on a Thursday night for a really innovative ETF structure. By the end of the day, Friday, we've got 12 copycats.
Do we need ETF innovation? I mean, to be a little cheeky about it, a lot of it allows for people to do leverage or kind of put products that aren't traditional. Like, if we just said, well, we want people to own wealth, fine. Right. But a lot of this stuff really veers more into the, trading, betting, leverage, margin. You know. I mean, I just wonder, we use the word innovation, but do we really need innovation in some of these areas?
So we are the most pro-innovation SEC ever. So we love innovation. We want to foster innovation. There's a real risk that when we sit around, and I think I'm pretty sophisticated and smart. I think I have pretty good judgment. But the idea that I'm going to sit in my office in Washington, D.C. and decide this is good for retail investors, this is not. I have decided.